Hello, good day. My name is Eli Kummi, Chair of Research Committee at Texas Capital and a Senior Lecturer in Finance at the University of Ghana Business School. So in this video, what I'm going to do is I'm going to discuss what asset allocation is and the factors that influence or drive asset allocation. So basically, when we talk about asset allocation, it refers to how we divide our assets, okay? So across different asset classes, across different sectors in the economy, and across different countries in the world. Now, when we say asset class, an asset class refers to securities with similar characteristics in terms of risk and return. So for example, stocks or shares are risky, and equivalently they have high returns. On the other hand, bonds are less risky compared to stocks, and consequently they have lower returns compared to stocks. Okay, so basically that's what we mean by asset allocation. You can see asset allocation like a pizza, okay? So if you have a pizza, how do we divide it across, let's say, stocks, bonds, and cash? Or how do we divide our assets across countries, different countries in the world? Or how do we divide our assets across different sectors in the economy? So basically that's what we mean by asset allocation. Now, what are the factors that influence or drive asset allocation? The first one is your age, okay? So typically younger investors can put more money into the stock market because they have more time to recover if the stock market is to collapse or crash. On the other hand, older investors or investors approaching retirement may not want to put too much of their money in the stock market because they may not have time to recover from a stock market crash. Indeed, older investors will usually rebalance their portfolio towards bonds, okay, as they approach retirement so that they can get more income from their portfolio. The next factor is your job, okay? And for example, if you're a civil servant, the cash flows from your job are stable or your salary is stable. And therefore, you can do a bit more risk by putting some of your money in the stock market. So technically, your job is like a bond. And therefore, in constructing your portfolio, you can put more of your assets in the stock market. On the other hand, if you are an entrepreneur or businessman who has volatile cash flows, then technically your job resembles a stock or shares, and therefore to provide stability to the portfolio, you may want to put more of your money in bonds. The next factor is your income or wealth, okay? Now, you may have heard a term that the rich will always get richer. Yes, that's true, and the reason is simple. Richer investors can afford to take more risk because if the risk goes wrong or if the returns don't materialize, they are not going to go hungry because they have enough money as a cushion for them. So income can also influence your asset allocation decision. The next factor is your marital status, okay, and whether you have kids or not. Typically, when people get married, they become more risk averse, maybe for biological and evolutionary reasons, because you want to be able to always provide for your family. You don't want to go and do an investment and then you can't pay your children's school fees, you can't pay their health expenses, etc. Okay, so typically married people tend to take less risk in their investments, and therefore they may put less in the stock market compared to maybe single investors. The next point is your level of risk aversion or risk tolerance. Naturally, some investors have a higher risk appetite compared to others. So if you have a high risk appetite, then you can take more risk, i.e. you can put more of your money in stocks, for example. And if naturally you don't like risk, you are risk averse, in that case, then you put more of your money in less risky instruments or assets. The final factor that influences asset allocation is the level of inflation. Now, if you observe critically, in countries with high levels of inflation, investors require protection against inflation, or investors require a hedge against inflation because inflation reduces their purchasing power, and consequently, they tend to put more of their money in the stock market compared to putting their money in bonds. So to summarize, asset allocation is how you divide your assets across different asset classes, different sectors, and different countries in the world. There are a number of factors that influence your asset allocation. Younger investors usually can take more risk. If you are a civil servant, you should put more of your money in shares. If you are a businessman, for example, you should put more of your money in bonds. If you are married, you probably shouldn't take a lot of risk, so you should put less of money in stocks. If you are rich or wealthy, you can afford to take more risk, and therefore you can put more of your money in shares, for example. If you are risk tolerant or you are risk loving, then you can put more of your money or investments in shares. And finally, if you live in a country where inflation is high, you can put more of your money in shares compared to bonds. Thank you very much for watching this video.